Hello everyone, I am Bhavin Vithlani. I am the portfolio manager for the SBI Infrastructure Fund and also cover the industrials and the capital goods sector as SBI Funds Management. Today, I will walk you through our views on the capital goods sector. The Indian capital goods sector has seen strong outperformance recently. The BSE Capital Goods Index has almost tripled from the COVID lows, which has outperformed the Nifty significantly. Now, this outperformance has come from a decade long of underperformance. So, between 2010 and 20, the capital goods index was almost flat, whereas Nifty nearly doubled during that period. Now, this long period of underperformance of 2010 and 20 came after what we can call it as a dream run, which is the 2003 cycle. Now, during that period, the BSE Capital Goods Index went up almost 23 times, outperforming the Nifty, which was up almost 7x during that period. Now, these sort of significant over and underperformance reflects the deep cyclical nature of the industry. Now let us understand some of the basics of the sector. What is the sector all about? Now, as per the recent report of the Government of India, the Indian capital goods industry is estimated to be about $40 billion in size. Now this is 12% of India's manufacturing sector. So it is an important element of the country. So the sector can be subdivided into multiple subsectors, which are electrical equipment, process plant equipment, construction equipment, and so on and so forth. So this is a heterogeneous sector, where not like a homogeneous one, the other sectors. So what drives the capital goods sector? Now the fortunes of the sector is very closely linked to the investment cycle of the economy. The demand for the capital goods can be broadly gauged under the three segments. Number one, the government investment in the infrastructure. Number two, the industrial capex. And three is investment in housing, which is the real estate. Now, all of these three sectors are currently seeing positive traction. The government capex started from 2015-16 onwards. Now the second derivative or the impact came very recently, which is what is reflected now in industrial capex and real estate. Now, a question that typically every investor's mind is, how is this current period different from the 2003 and 2007 period? In the previous cycle, when we go back to 2003-07 period, the upcycle was very narrow as it was led by a handful of sectors, and especially the coal-based power generation sector, and a few core sectors like the metals, oil and gas, cement, etc. Consequently, what we saw was that the electrical and the power equipment companies drew a lion's share of the investment. So we saw a large part of the up move was concentrated in some of these power equipment companies. However, that cycle saw excessive investment by the end consumer, which eventually resulted in a long period of severe downturn that was much longer than the previous cycles that we have seen. Now, if we come to the current cycle, we are seeing that it is showing initial signs of the rally being more broad-based one. Now, we see three key differentiators why we believe that the rally of the sector is very broad-based. One, the strong thrust of the government and the government will to increase the share of manufacturing to 25% of GDP from current 15-16%. And we are seeing visible efforts on the ground through some of the reforms like Atmanirbhar Bharat, production link incentives, etc. Second, energy and transportation are bedrock of the capital goods sector, not in India but globally. Now, these sectors are undergoing a major transition. As an example, coal to solar, internal combustion engine of a car to EV, hydrogen, etc. Now, these transitions is resulting in recreation of the entire value chain. So this is a very big structural driver. And third is we have seen improved competitiveness of Indian companies vis-a-vis the global players, especially the Asian players. And hence, these companies are at best position today to capture the realignment of global supply chain, which is the China plus one, thereby aiding their exports. Now, what changes did we see during the downturn, which is very important to learn, which is the 2010-20 period. Now, this is a decade long of capex holiday. So, what we saw, but naturally, there was a significant consolidation in the capital goods sector. This lean period was used by the industry leaders to enhance their competitiveness. So, they right-sized, indigenized, and also increase the share of exports and spares, thereby you reduce the cyclicality. Now, capital goods is a knowledge-driven industry, whereby one has to continuously invest in R&D to remain relevant. Now, contrary to the multinationals, we observe that only a handful of Indian companies invest in R&D. Till date, many players of Indian origin have relied on borrowed technology, which is through the licensing agreement along with the MNCs. Now, as the Indian market is becoming more relevant, most of these MNCs have come to India now. So, some of these companies who have relied on borrowed technology are finding it very difficult to get the technology on a continuous basis. So now, the other observation that we have, besides the technology getting difficult to get, is that the nature of the client, which is the industry, there is a change in their outlook, because these companies are now competing on the global arena. So we have seen an increased reliance on automation to up their quality and productivity. And this is a big change in the buying behavior. This buying behavior, along with the difficult to access technology, is driving consolidation in the sector. Now, the other question that commonly is asked is, what are the key drivers of the sector going forward? And why it is different? Because we have had multiple false start in the 2010 to 20 time period. And the 10 year was a long period of frustration. So, the reason we believe the differences are the government's reforms on India's manufacturing are resulting in entry of newer sectors. As we said, this rally is more broad-based. So, we have seen sectors like electronics, aerospace, defense, solar, hydrogen are entering India through PLI schemes or indigenizations, etc. Now, capital goods sector globally is dominated by some of these sectors like aerospace, defense, etc. And hence, we see the sizes of the global capital goods is significantly larger than India. Maybe we could say the size of India market is so tiny that it is less than 5% of the global market. Now, as these sectors such as electronics, aerospace and defense, they come into India, they set shop here, and they become the consumers of the capital goods in India, the size of Indian capital goods industry can actually grow exponentially. And hence, what we believe that the size of India's capital goods industry can grow exponentially from here on. And we believe that this growth can be for most of the sub-segments of capital goods. An added advantage to this driver would be realignment of global supply chain, wherein Indian companies get an additional export benefit. One of the common questions asked by our investors is on our stock selection criteria. The underlying factors for the stock selection are same, they don't change. Basically, we look at companies which have good management, they have a strong competitive advantage, and they have a long runway to growth, and we are buying at reasonable valuations. But when it comes to capital goods sector, we need some additional filters here. So, because of the risk mitigation. So, one that we see is the product should not be prone to disruption. If a product has a high dependence on coal, then we see disruption. We prefer the companies to have a diversified end user base and diversified geography, so that if one of the sector is impacted, we don't see a significant impact on the entire company. We also look at what is the share of aftermarket or spares and services, which kind of reduces the cyclicality. So if a company is consumable in nature, even better. We also look at the investments in R&D. The R&D cult is very important, and the innovations that the company is focusing, that as we see the energy transition, does it have any product which can benefit it? Now lastly, what about the valuations? How different are we versus the past cycle? Now, when we go back in 2003, the starting point of the valuations were very low. Now we look at market cap to sales, because PE is very volatile. Due to the cyclicality, the margins go up and down. Market cap to sales kind of evens out some of the cyclicality. So when you go back in 2003, the market cap to sales of most of these companies were less than 1 time. Now when we look at the way the stock prices have jumped significantly, especially over the last 2.5 years, the current valuations are more than 2 times the standard deviation of long period average. So while we are positive on the longer term prospects, the lofty valuations makes us cautious in the near term. So at SBI, the infrastructure fund that we manage mirrors the thought process that we spoke about. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.